Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Welcome to the only show in the country dedicated to helping savers worry less about money, the Worry-Free Retirement, with your host, retirement specialist, and six-time author and fiduciary, Tony Walker.
When you think about retirement, the biggest concern of most hardworking savers I meet is how to stop working and replace the paycheck offered by their employer all their working lives with a new form of paycheck, complements of their 401k plan. It's a great question and one that is always in the forefront of my discussions with the many savers I meet each week, whose question always has a tagline, and it goes something like this. Tony, when I do take money out of my 401k in retirement, how much in taxes will Uncle Sam take? To which I always reply, well, that's easy. The more you make, the more he takes. And with more than 11,000 people turning 65 each and every day, you can bet your 401k on the fact that you are on the radar of the financial world with a ton of advisors promising you the moon, with ideas they say will save or even sometimes eliminate the taxes you will owe on your 401k plan, which in some cases can be the case, but in most cases, you're going to be sold a bill of goods. Which is why today I'm going to cover 3 different cases I worked on recently of savers who approached me for a second opinion on what I refer to as the tax tumor, and how different all 3 of these saver situations are, and how we at Tony Walker Financial might address reducing their tax tumor, while at the same time making sure that they don't get too hung up on it. You see, while taxes are important to address and dealing with one's tax tumor is certainly a must, it is not the only reason you should turn your 401k over to just any advisor. That's because saving on taxes is a piece of the retirement game plan you will need, but it's not the only piece of the game plan in terms of how much you can comfortably spend each week, each month of that money that you are going to take out of that tax-infested 401k plan. It's like a tax attorney told me years ago when I first got into the retirement planning business. He said this: if the only reason you are making a financial decision is solely based on saving taxes, in the end, you'll more than likely be disappointed in that decision. Which proves my point of why having a game plan, along with an experienced local retirement planning firm to help you deal with your tax tumor, is a must, which is why today's show is entitled, The Effects of the Tax Tumor on Your Income. Stay tuned. I'm Tony Walker. This is the Worry-Free Retirement, and we will be right back.
The following clients were not compensated for their testimonials of Tony Walker Financial. Their experience may not reflect the experience of all clients and is not a guarantee of future results.
Want to know what savers were saying right before the stock market crash of 2008?
At our age, we just don't want to be on the roller coaster of the stock market anymore.
I'm not satisfied with my mutual funds at all.
Stop putting your money at risk when you don't have to. Learn how to safeguard more of your retirement savings by logging on to TonyWalkerFinancial.com or call 877-499-9255. Warning: a licensed insurance agent with no prior knowledge of annuities can legally toss your 401k into an annuity. Don't make that mistake. Log on now to TonyWalkerFinancial.com before ever purchasing an annuity. Did you realize that you have a partner when it comes to your 401k plan? His name is Uncle Sam. And depending on your overall tax bracket and income, his fair share of this partnership involving your 401k could be as high as 40% when you include both federal and state income taxes.
No, really?
In essence, what you see on that 401k, IRA, 403b, 457, or TSP statement is money that are in these plans, assuming they are pre-tax, that is not really all of your money. This partnership and the taxes buried inside your 401k is what I refer to as a tax tumor, a cancerous situation that reveals the following. As your 401k grows in value, so too does the size of your tax tumor. And unlike your normal tumor that you and I might get in our body, the tax tumor doesn't ever go away, even after we die. That's right. This tax tumor gets passed on to your kids when you die for them to then have to deal with. What a deal, right? Oh, speaking of tumors, man, did my wife Susan recently have a huge scare following a recent knee surgery procedure. To make a long story short, as she was coming out of knee surgery, they had a dickens of a time getting her oxygen levels back to normal. After days of serious breathing issues, a CT scan was performed, revealing a huge mass in her thyroid, which was severely occluding her airway. Not truly knowing what this potential tumor was, a biopsy revealed it was not malignant, but simply a goiter, as they call it, that needed to come out and pronto, which she had another surgery to remove it, as the surgeon discovered that once he got in there, this mass was actually the size of a grapefruit. The point being, Susan didn't even know this tumor existed, and neither did anyone just viewing Susan from the outside world. In other words, she looked perfectly normal, and to the naked eye, the tumor was neither visible nor painful. Rather, it took another circumstance, her coming out of surgery not able to breathe, to detect her tumor, and then after seeing what was going on, someone with the expertise in such matters to safely remove it, which is our role at Tony Walker Financial, not to deal with tumors inside one's body, but rather the tumor of taxes buried inside our accounts held by our retirement accounts of our clients. Those taxes that have yet to been paid. And just like Susan's tumor, if left unchecked, this tax tumor of yours is going to get bigger and bigger over time. So what I thought we'd do is take a look at 3 different cases we worked on recently to see the effects of the tax tumor on these 3 savers' income and their financial circumstances. Oh, by the way, the folks that need to pay close attention to this and these 3 cases, this would be the following. Anyone already retired, anyone who is thinking of retiring in the next few years, anyone at or near the age of 59 and a half, or maybe someone who's recently been offered a buyout or to leave their work early. Pay close attention, but before I get to these 3 case studies, let me go over this graphic very, very closely. This is the one graphic we call the more you make, the more they take. You see, folks, we live in what's called a progressive tax system. So the more money that comes piling onto your tax return actually can throw you in what's called a higher tax bracket. I call this tax bracket creep. And as you can see on a federal basis, these rates are as high as 37%. Now keep in mind, as we record this show in June of 2025, the tax laws as we know it are about to expire and could go back to 2017 rates. We don't know what Congress is going to do, but nevertheless, over the long term, my concern with tax rates is they're probably going to go up in the future. I mean, where are we going to get revenue to pay off $37 trillion in debt? So this is something you need to focus on now. Even if you're not retired, you need to be thinking ahead of this and realizing that down the road, these taxes could go up. And as you're going to see with these 3 different cases, the people are affected differently based on their individual circumstances. Okay, so case number 1, this is a 57-year-old married male. So let me just kind of read the parameters here. Incidentally, he married, like me, to Susan, his high school sweetheart. He didn't marry Susan, actually, but he married his high school sweetheart. Now, she stayed home and raised the kids until about 10 years ago when they kind of felt like they needed more long-term health insurance. So she went to work in the school system where she could have health insurance for both her and him if he retired early. He worked out of high school. He's been with the same manufacturer ever since. He's getting to a point, he said, that he's getting a little burned out. He's heard, since he's not 59 and a half yet, that if he takes money out of a 401k now, there's a 10% tax penalty, so he wanted to go over that. He makes about $75,000 a year. His wife likes working in the school system, and while she doesn't make a lot of money, again, the health insurance is taken care of, plus she's off during the summers and those types of things, so she likes her job. She actually will be eligible for a pension in about 7 years, so she plans on working another 7 years so she can get that pension. If he were to retire now, he would get $2,500 a month. So there was a pension that was offered to him when he started work. So he's got that going for him if he decides to retire. He also has about $800,000 in his 401k plan. So this guy has been socking money away. The market over time has done good. So he's got a lot of money in there. Although actually in this case, he didn't think it was much money. I thought it was a lot of money. Then they recently offered him a buyout. So here's a guy thinking about retiring, doesn't think he can pull it off. They offered him a buyout, and here's the catch. If he stays till the end of the year, he's going to get an $80,000 bonus to stay. And he's like, I think I got to stay. So he's going to stay, but he wants to know if he can take this buyout because he got to let them know pretty soon. He can't just let it waver. He's got to tell them something. Of course, look at the initial numbers. I've done this for years, folks. I said, no worries, you're going to be able to take the buyout. Tell him you'll take the buyout. Now, we're going to work on an income plan to show him the details. But basically, he's going to probably take the buyout. He is having some health issues. No wonder. He's been working, on the plant floor for all these years. And he basically said, Tony, I'm burned out. I just want to enjoy life a little bit and kind of spend more time with the family. And then he brought up the tax tumor to me. He said, I'm worried about this tax tumor on this $800,000 401k. It's all pre-tax. What in the world am I going to do about it? So kind of let's look at this case in detail. His condition is what we call burned out on work. And to the rescue is all of a sudden a buyout. So he's very, very intrigued about this buyout, and it has spurred him on to thinking, maybe I need to retire, okay? The diagnosis for me, after glancing at this, and again, folks, I have worked on over 5,000 written game plans. I've seen nearly 20,000 people in person. I've done this over 40 years. I know what I'm looking at, and I can quickly diagnose the situation. And as I told him, you could easily retire now. Now, again, there's been some other work that's gone into this. I won't share in detail that we talked about. Gets a little personal, but I knew for a fact this was a good time to him to do that. And then he said, well, Tony, I'm only going to be 57, and I'd like to take some money out of this 401k, but I don't want to incur that 10% tax penalty since I'm under the age of 59 and a half. Again, we're very experienced in something. This is a government freebie, if you will. It's called a 72T election. You got to know what you're doing. But yes, we can send him regular installments to supplement the pension, supplement his wife's income. Again, she's going to be still working, and avoid that 10% tax penalty. Pretty cool case. If that sounds something like you, we need to talk. All right, let's go to case number 2. And we're moving right along. This is working out well. Okay. Now this, again, these are cases I've worked on, folks. This is all I do every day of the week. I meet 20 to 30 people per week. So I'm in the trenches. We've got great fiduciaries that are on standby to help once people become clients, but I'm on the front lines meeting with all these people. Here's a 64-year-old divorced single female. Let's read a little bit about her situation. For the first 20 years of her marriage, she stayed home while her husband worked. He made big money, and I will just put it that way, but they went through a divorce, okay? Married 20 years now. She had to go back to work because she needed extra income, makes about $40,000 a year. Over that period of time, not only has she put money in her 401k, but through something called a quadro, she was able to get some of her husband's 401k and move it into her name, so she has about $400,000 in a 401k. Has about $20,000 in savings. As you can imagine, hard to save a lot of money making $40,000 a year. Her home is in good shape. However, she is going to need a car. Like our last gentleman, she's just pretty burned out on work. She also recently received a $200,000 inheritance from her mother. Now, I asked her specifically about that. About $100,000 is what we call after-tax money. Another $100,000 is an IRA that she hasn't paid taxes on. Keep that in mind. She's in very good health. Has a child, though, struggling financially and thinking about allowing her child, who's divorced, and her grandchild, the child's child, to move in with them because she's trying to help them out and they're having trouble out there. Her ex still makes really good money, and she asked if there's any way she could draw on his Social Security since they'd been married more than 10 years. I told her that she could, and we're going to look at the numbers, but more than likely, it's going to be more advantageous for her to draw on his Social Security and give her more income because of the 10-year marriage rule there on the divorce. She still owes $150,000 on her house. It's at a 6% interest rate. She's wondering if she should pay that off with inheritance money. She doesn't understand the tax tumor, and she has this $400,000. In fact, when I started talking to her about taking money out, I think she was under the impression she didn't owe any taxes. So I told her if she wasn't careful, she could move into that 22% bracket pretty quickly, which she was not aware of. So, and she is worried about the cost of health insurance if she leaves her employer's plan. So getting ready to approach 65, that's not going to be a big deal. She can get a Medicare supplement. We have resources to help her get those. So in her case, here's what I'm going to recommend she do. Pay off the house. That'll help her cash flow, get out from under that 6% note, and use the mother's money to do that. And we're going to help her figure out the taxes on that. So again, folks, Tony Walker Financial is a full-service planning firm. I've seen about everything under the sun. I've done this so long. Every once in a while, somebody will throw me a little curveball that I hadn't seen, but I know these situations well. I can size them up very well. I personally work on the game plan. We have that wonderful income planning department who is dedicated to making sure these income plans match your situation. That's another thing, folks. You folks are on YouTube watching all these crazy videos. There is no way you should be taking advice from a YouTube video without meeting with a retirement planning specialist to make sure all these ideas they're throwing out are suited for you. In fact, we're going to see that in the next case. So in summary, let's look at what I came up with. Her condition, retire now, take care of her daughter and granddaughter. That kind of, by the way, that kind of covers the live well, die broke philosophy. Folks, many of you are putting off doing things deep down you know you should do. I would encourage you to order a copy of Live Well, Die Broke. The whole philosophy is enjoy your money while you still can. You can't take this stuff with you. And I'm telling you, with the tax tumor, the longer you leave that money alone, it's going to come back to bite you. So enjoy the money now. Get with a retirement specialist and take a hold of that philosophy of Live Well, Die Broke. I guarantee you'll be glad you did. Diagnosis, take advantage of ex-husband's Social Security income. And again, treatment, we're going to pay off that house with the inheritance, and we're going to turn that 401k plan into that beloved money. Okay, good stuff. Again, if this kind of fits your situation a little bit, give us a call. Go online, TonyWalkerFinancial.com. Be happy to talk to you at no obligation. All right, finally, case number 3, 72-year-old married couple. All right, this is an interesting case. Let me read this. He is 72. Actually, she's around 68. He has over $1.5 million in his IRA. Okay, never touched it, doesn't need the money. She has about $200,000 in her IRA. Between his pension and their Social Security, plus they have some CDs kicking off interest. Incidentally, all these high interest rates on these CDs, throwing some of you on a higher tax bracket, so kind of be careful of that. But anyway, total income's around $100,000 a year. I mean, they don't have any debt. They don't really do a lot anymore. That's plenty of money. But as he puts it, this IRA is a concern because he knows taxes are due. In fact, last year he watched a YouTube video, followed up with some broker at the bank, and he converted $150,000 of his IRA over to a Roth. Well, little did he know when he did that, there was complications with IRMA. That's now his Medicare premiums went up. He had to pay a bunch of taxes, which threw him in a higher bracket. So again, there was really no thought to the rippling effect of converting this Roth. But he just did it anyway, and he told me, he said, man, I probably shouldn't have done that. But again, that's what happens when you rush out and do stuff without a game plan from a trained retirement specialist, all right? He is worried that next year when he turns 73, that's the age that he must take money out of that 401k. That's called the required minimum distribution, or RMD. He doesn't understand that. He's concerned about that. He does have about $350,000 in after-tax money in savings and CDs, so he's got plenty of liquidity. 3 children, 2 of them are doing great. One of them's not doing so well financially. He is really worried about that child and feels like he needs to help them. So a couple of things here. He's wondering if he should give some money to the kids now. He has the pension that could go down to 50% if he dies first. His wife's going to lose her Social Security if he dies. He is a little concerned about that. He's had some health issues. He had cancer in the past. He's in remission, but he's thinking, I want to make sure my wife has plenty of money if I were to die first. He doesn't know how to look at that. And then finally, she's got a very long life expectancy in her family. She's 4 years younger, and she is worried about possibly one day going to a nursing home and just eroding their wealth. So, pretty complicated case. This stuff, folks, is right up our alley. This is why I have 19 full-time people. 3 of them are full-time fiduciaries. I have 2 tax-certified people on staff. This is the kind of stuff we love to work on cases like this. It's kind of like that fella that did the surgery on my wife. He knows what he's doing with thyroids. We know what we're doing on these kind of tax planning cases. So let's take a look at that. The condition is he's got a humongous tax tumor. Folks, on $1.5 million, I mean, let's just say he wouldn't do this, obviously. But let's say he tried to take it all out or convert it this year. He's going to owe 40% on $1.5 million. What is that, $500,000-$600,000 in taxes? Yeah, that would be crazy to do that. Now, the problem is if he passes away and his wife and him don't use it, the kids are going to be saddled with the tax tumor, and they're going to have to deal with it, listen, in 10 years. That's the new law. That's not good for the kids who might inherit that. Diagnosis, there is no written game plan. This is the biggest obstacle I see. People come to me. They may have a broker. They got an advisor. They bought something from a guy at a dinner seminar, whatever it is, but they have no written game plan to help them make these crucial decisions that you're going to have to make in retirement. Obviously, the RMD is not being planned out. Now, All kinds of cool stuff on his treatment plan we can do. We could do something called a QCD, Qualified Charitable Distribution, which would go to charity directly with his RMD. That would help his taxes. We could accelerate money coming out. You might say, wait a minute, isn't he close to the 22% bracket? Yes. If we accelerated distributions, it could affect his IRMA. It could throw him in a 22% bracket. But the way I look at it, these tax brackets are still very, very low. And this $1.5 million IRA with this huge tax tumor ain't going anywhere. And in my view, probably over the long time, it's just going to make matters worse. So we would accelerate and do some gifting strategies, and then we do what's called immediate pay down. So that's part of what we do in our office, is to look at those strategies, tie the income back, and try to keep that tax tumor mitigated and as low as possible. So folks, if all this looks good to you, but you don't have a retirement planning staff that can be there for you to help you, why don't you do this? Take advantage of contacting me, Tony Walker. Just log on to TonyWalkerFinancial.com. We're going to set up that no obligation 10-minute fiduciary phone call. And if you'd rather just give us a call anytime, that's fine at 877-499-9255. This is the Worry-Free Retirement. We'll be right back. It is estimated that each day over 11,000 people will turn 65, which means a lot of advisors selling a lot of annuities. Don't get stuck in the wrong annuity. Get a second opinion from TonyWalkerFinancial.com.
Are you retired or retiring soon? Do you have a 401k, IRA, 403b, thrift savings account, or lump sum pension that you'd like to move to safer territory? Did you know that all the money you see on your 401k statement isn't really yours? Depending on your overall taxable income, the government has essentially a lien on your 401k that can tax as much as 40% of your money when you go to take it out. Tony Walker calls this the 401k tax tumor. For over 40 years, retirement specialist Tony Walker has helped thousands of savers worry less about money by creating game plans to deal with your tax tumor. Get control of your retirement by controlling the taxes owed on it. Schedule a free meeting to see if you can reduce your tax tumor and provide a guaranteed income you can never outlive. To get started, simply log on to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com.
Welcome back to the Worry-Free Retirement. In our time remaining, I thought it would be interesting to explore in more detail this concept of tax planning. Tax planning in the income world of retirement is a relatively new field. Back when I got in the business in 1984, it's wild thinking of the recording of this show in June of 2025. I've been in this business 41 years. But back in the late 80s, early 90s, I really got involved in tax planning for what's called estates. We called it estate tax planning. In fact, back then, armed with my CLU, and I was in charge of the estate planning council in Bowling Green, which included attorneys and CPAs. One of the things I enjoyed doing was going out and finding people who had fairly large estates or real estate. And back then anyway, they didn't know that you could only pass up to $600,000 per person without falling into estate taxes. And you think the income taxes are bad. Back then, the estate tax rate started at 37% and went as high as 60%. So it was a huge issue, and our job was to go in there, try to get all the estate assets realigned, consider what trusts we might want. Do we want to buy life insurance funded with trust, gifting? And I worked under some great mentors and worked on some very large cases. So I got very experienced in what's called estate tax planning. Now, I don't do as much of that anymore. In fact, when I started focusing on retirement planning right after 9/11, I began to learn retirement income tax planning. And this was a very new field back then. In fact, it was kind of funny. I remember going to a CPA conference in Bowling Green with about 120 CPAs there for continuing education. And in that meeting, it was a 2-day meeting, I was excited to hopefully learn some more about tax planning for retirement planning. And after they went through all the other stuff, by the way, CPAs have to keep up with so much stuff, farm credits and all this stuff. I was interested in none of that. I was sitting there bored, just trying to hang in there and get my CE credits. But anyway, finally we got to the section on planning for retirement and taxes. And the gentleman who represented the topic, first of all said, "Gentlemen, I don't know much about this, and we're going to keep this real brief and move on." Which reminded me back then, very few people knew anything about tax planning. for retirement. This is why shortly after that, I signed up with a Mr. Ed Slott, CPA. He's a well-known author and CPA, and attended and was a member of his first ever what was called Elite IRA Advisor Program, because I wanted to learn about tax planning for retirement. Another gentleman that was very influential back then was Bob Castellone, the founder of Leap Systems. I went to many of his conferences and learned a lot about macroeconomics, tax planning, how to calculate properly Roth conversions, things like that most people had no clue about. So I'm very, very thankful that at a young age, I guess I sensed that this was going to be a need with all these baby boomers that would be retiring one day, and here they are, 11,000 every day, hitting 65. There would be a huge need for somebody who had expertise in tax planning for retirement income, which is what we do at Tony Walker Financial. Among many things, obviously we advise people on money. We manage money through our Charles Schwab platform. We sell a lot of annuities, occasionally sell life insurance. One of our goals is, as we're working with larger accounts moving into retirement, is letting them know that we will be there for the long haul to help them with tax planning. And here's my concern, folks. Many of you, I know this for a fact because I get these same darn invitations in the mail, are getting bombarded with dinner invitation seminars about tax planning, people on the radio promising to save you a gajillion dollars in taxes. Please be very, very careful. Some of this stuff I'm seeing, I don't think these people understand what they're doing. One of the ploys lately is to use life insurance for retirement income tax planning. It can be done, but it is fraught with some potential dangers there. And a lot of the assumptions these advisors are making are totally out of bounds and probably are going to fall by the wayside. But it's going to land on you. It ain't going to be a problem until 10 or 15 years from now. The advisor is probably going to be retired and you're stuck holding the bag with some life insurance policy that's not probably going to do what they said it would do. So here's what I would suggest you do right now. If you are retired or retiring soon and you're thinking about this idea of tax planning, what it is, you need to understand that tax planning is perfectly legal. In fact, I think it was the late great Judge Learned Hand that said the law does not require anybody to pay more in taxes than the law requires. The problem is a lot of people can tout tax planning because it's, quote, legal, but they can still get you in a world of hurt down the road. Now, the second thing I would caution you about, please be careful. Many of you are rushing out and jumping into these trusts. And while I don't have a problem with living trust and irrevocable trust, I don't know, I just don't think a lot of thought is being put into these trusts because the attorneys who set them up are not being given a game plan. They're trying to do the best they can, but let me give you an example of a catastrophe recently. The people had a large amount of individual stock with a low cost basis, meaning if they were to sell it, they would have a huge amount of capital gains, and he did not want to sell it. He dies, he passes away, but the trust owns the stock. So the problem is now his wife, who's also a member of the trust, she's a trustee now, but the stock cannot come out of the trust until she dies. She does not get what's called a step-up in basis. So if she wants to sell that stock, she's got to pay capital gains. So all they had to do in pre-planning, if anybody was involved in this, was if he had cancer, was getting ready to pass away, or let's say he's older, or we're betting on the come that he will die first, transfer that stuff out of the trust, assuming if you can get it out of there, depending on how the trust was set up, put it in his name. That way, when he passed away, which he did, all of that stock gets a cost basis that gets stepped up. Now, all the capital gains are gone if she decides to sell that stock. So that's another thing, folks. You're rushing out and getting a lot of these trusts. You need to make sure you're letting the attorney know, what are you trying to accomplish? Is it to avoid nursing home costs? Is it to qualify for Medicaid? Is it to save on taxes? Is it for privacy issue? Is it concerns over wayward children or special needs trust? But please be very careful on these trusts as well. Now, here's my advice. If you're retiring soon, maybe you're a saver and you just really feel like you need a competent advisor that can not just sell you something now, but be there for the long haul to help you with all these tax planning issues, give us an opportunity to talk by phone. It's absolutely free. And I'll be talking to you by phone and putting my 41 years to experience to work to see if we can help you. Just log on, TonyWalkerFinancial.com, click on that Let's Get Started, TonyWalkerFinancial.com, or you can call us anytime at 877-499-9255. Well, that's all the time we have on the Worry-Free Retirement. We've enjoyed being with you, but you remember, between now and next week, if all else fails, you be worry-free and you make it a good one.